Welcome in. It is fantastic to have you joining us for today's deep dive. We have a truly incredible journey mapped out for you today.
We really do.
Yeah, we're going to be unpacking excerpts from this legendary 1923 financial classic, Reminiscences of a Stock Operator by Edwin Lefèvre.
Which is just a foundational text.
Absolutely. It follows this anonymous protagonist's lifelong journey, going from a 14-year-old chalk boy, just writing prices on a blackboard, to becoming an absolute titan, a Wall Street millionaire.
It's quite the arc.
It is. But our real mission for today isn't just a history lesson. We're looking to extract the timeless psychological nuggets, the hard-won rules of speculation buried in these pages.
Right, because those rules apply to everything.
Exactly. Not just the financial markets, but mastering absolute any complex system in your life. Okay, let's unpack this.
It really is a brilliant text to dive into. You read this book, and keep in mind it's over a century old, and you immediately realize that human nature hasn't changed one bit.
Not at all.
The real story jumping off the page isn't just about a guy making and losing millions of dollars. It's actually about a relentless feedback loop.
Yeah, that agonizing process of making mistakes.
Making mistakes, analyzing them completely without ego, and forcing himself to adapt. What's fascinating here is how the protagonist eventually learns that beating the market itself is an impossible task. You can only learn to read it, and more importantly, you can only learn to beat your own worst impulses.
I was just blown away by how early that learning process starts for him. I mean, he's 14 years old, fresh out of grammar school.
Just a kid.
Just a kid, working as a quotation-board boy in a stock brokerage office.
Mm.
And because of his age and his deeply analytical mind, he doesn't look at the board and see dollars and cents. He doesn't see companies.
He just sees numbers.
Numbers and patterns.
Yeah.
He realizes these numbers change constantly, and he starts to notice habits and how they move. He even starts a little secret notebook to test his memory.
Trying to predict price behavior based on past performance.
Exactly. And I loved reading about his very first trade. An older office boy comes to him with some dope like a tip on Burlington stock.
They pool their money, right?
Yeah, they pool a grand total of $5 to buy whatever they could carry. 2 days later, they cash out. And our protagonist makes exactly $3.12 in profit.
$3.12.
Yep. But that tiny profit is the spark.
And that spark really catches fire when he enters what were known as the bucket shops. Now, to grasp his early success, we have to look at how the text describes this specific era.
Because it's very different from today.
It's completely different.
Yeah.
You have to remember, he wasn't trading on the real Wall Street yet. He was in these wild places that operated nothing like modern brokerages. In a bucket shop, you didn't actually buy or sell real shares of a company on an exchange.
You were just placing thin bets on the price fluctuations as they came over the ticker tape.
Right.
It sounds almost like an off-track betting parlor for stocks.
That is a perfect way to think about it.
Yeah.
And they operated on a razor-thin one-point margin.
Meaning, if the stock moves against you by 1 point,
You're out. If you bet a stock would go up and it dropped by just one single point, your margin was exhausted. Your bet was wiped out automatically.
for gambling.
Pure gambling on the immediate second-by-second fluctuations. But for someone with his specific mathematical mind and relentless pattern recognition, it was the perfect arena to hone his skills.
He gets so good at it that the smaller shops actually ban him from walking through the doors.
They start calling him the boy plunger.
The boy plunger. By the time he's 20 years old, he has amassed $10,000. He's trading at the Cosmopolitan Stock Brokerage Company, which the text notes is the biggest in New England.
And this brings us to that incredible story about intuition.
Yes, so he is currently short 3,500 shares of sugar stock. And just to clarify for you listening, being short simply means he placed a massive bet that the price of the stock was going to drop.
And the market is acting exactly as he predicted.
Right. But then suddenly, he gets this unexplained, uncomfortable hunch. He describes it by saying the engine wasn't hitting right.
I love that phrase.
It's so visceral.
Yeah.
He has no logical reason, no news is broken, but he abruptly forces the clerk to close his entire trade at a price of 103.
The so what here for you listening to this is what happens just moments later. Almost immediately after he forces that trade closed, the price of sugar on the ticker tape abruptly spikes to 108.
A huge jump.
A massive jump. The bucket shop knew they had a ton of money from local traders betting against sugar, so they orchestrated a drive.
They secretly used their own brokers in New York to artificially bid up the price on the real exchange.
Exactly. They only needed it to spike just high enough to trigger that 1-point margin and wipe out all the local shorts in their shop.
Wow.
The protagonist's subconscious pattern recognition, that strange feeling that the engine wasn't hitting right, saved him from total financial ruin. This introduces a core theme of the text, which is the incredible power of intuition.
But the author is careful to point out this isn't magic.
No, not at all. It is an intuition built on thousands of hours of intense, focused observation.
But the irony is that his massive success in the bucket shops eventually becomes his downfall. At age 21, he takes his $2,500 stake, moves to New York, and starts trading on the real stock exchange.
And he goes completely broke.
Completely broke. Reading this, I had to stop and ask myself, wait, if he had a foolproof mathematical system that made him 10 grand in the bucket shops, how on earth does he go instantly broke on the real Wall Street?
Well, the text points out a massive mechanical difference between the two environments, one that he completely failed to grasp at first.
The execution speed.
Yes, in a bucket shop, when he wanted to trade, he got instant execution at the exact price printed on the ticker tape at that very second.
But on the real exchange, there is a delay.
By the time his order reached the chaotic floor, the price had already changed. Furthermore, when he traded in large volumes on the real exchange, his own massive sales would actually depress the price of the stock.
He was trying to blindly play the old game in a completely new arena.
Precisely.
So what does this all mean for you? It means that a winning system in one context can be absolutely fatal in another if you don't take the time to understand the underlying mechanics of the new system. You can't just copy and paste your strategies in life and expect the same results.
That's a huge takeaway.
Now, while he is struggling to figure out New York, he meets one of the most memorable characters in the entire text. Mr. Partridge, a veteran trader, affectionately nicknamed Old Turkey.
Old Turkey is great.
There's this fantastic anecdote where a younger, frantic trader named Elmer Harwood runs up to Old Turkey. Elmer says he just sold his Climax motor stock, taking a nice 7-point profit, and he intensely pressures Old Turkey to do the same.
Predicting the stock will dip so they can buy it back cheaper.
Exactly.
Old Turkey's response is legendary in financial circles. He looks genuinely distressed by the advice and refuses to sell a single share.
Right.
When Elmer demands to know why he won't take a guaranteed profit, Old Turkey simply says, "Well, this is a bull market, you know." He explains that if he sells, he would lose his position.
Let's break down what he means by losing his position, because that seems crucial. He's basically saying that in a bull market, a market where the overall long-term trend is pointing aggressively upward, the hardest thing to do is secure a good, cheap entry point.
Precisely. If Old Turkey sells his shares just to make a quick buck on a temporary dip, he is gambling that he can time the market perfectly to buy back in.
And if he gets it wrong, the stock keeps soaring and he is left behind.
If we connect this to the bigger picture, Old Turkey represents a massive evolutionary leap for our protagonist. It marks the shift from gambling on daily, minor fluctuations to speculating on the big swing.
The big swing.
The profound lesson here, which the protagonist admits takes him years to fully absorb, is that it is never your thinking that makes the big money. It is your sitting.
You're sitting. I love that.
You must have the courage, the conviction, and the patience to sit tight and ignore the daily noise. You cannot catch all the minor fluctuations. Trying to outsmart the daily noise will just cost you your position.
That transition from trading the daily noise to trading the big swing sounds brutal. And a big part of that growing pain is learning to trust yourself instead of listening to others.
It's a hard lesson.
The text shares a wild story about him making a massive $250,000 profit by shorting Union Pacific stock. He did this on a pure, blind hunch while on vacation in Atlantic City, right before the devastating San Francisco earthquake.
Such a contrarian move.
And here is the kicker. Even when the market bizarrely ignored the news of the earthquake for 2 full days and prices stayed high, he doubled down on his short position,
He trusted his read over the market's temporary delusion.
knowing the underlying value of the railroad was literally destroyed.
Now contrast that brilliant independent conviction with the absolute disaster that happens to him later in Saratoga.
Oh, the Saratoga disaster.
He was watching the tape and accurately saw that Union Pacific stock was being accumulated.
We should define that for the listener. Accumulation means he could see in the trading patterns that corporate insiders were quietly buying up massive blocks of the stock.
Which is usually a sign that good news is coming.
Right.
He started buying it himself, correctly reading the signs. But then a very smart, Well-meaning friend named Ed Harding called him.
Harding aggressively warned him that he was being a sucker, insisting he had inside information that the big players were actually shoveling the stock out and dumping it.
The result is painful to read. He abandons his own verified read of the tape. He lets his friend's insider paranoia shake his confidence.
He sells his long position and actually flips to betting against the stock.
The very next day, Union Pacific declares an unprecedented 10% dividend.
The 10%.
The stock absolutely soars, and he takes a $40,000 loss.
It feels so relatable, honestly. It's like doing weeks of fundamental research on a company, deciding it's solid, and then dumping your shares because your buddy texts you a rumor he saw on a crypto message board.
Exactly. The protagonist notes that $40,000 is a low price to pay for learning to have the courage of his own convictions. This is a vital takeaway from the text.
Tips are incredibly dangerous.
Not just because they are often factually wrong, but because relying on them fundamentally severs your trust in your own verified data and your own methodology.
If you buy a stock because of a tip, you are forced to sell on the tip.
You surrender your autonomy. The text makes it clear. The greatest enemy of the speculator is not the market, it is the susceptibility to the opinions of others.
Which brings us to his absolute masterpiece, the climax of his early career.
The Panic of 1907.
By this time, he has finally evolved past staring at the daily ticker tape and has begun to study basic conditions. He is looking at the macroeconomy.
He notices a seemingly boring newspaper advertisement
stating that the Great Northern and Northern Pacific Railroads are issuing new stock to investors on an installment plan. Here's where it gets really interesting. He sees that boring ad and immediately realizes it is essentially a signed confession from the bankers.
It means the money market is completely dried up.
If the most powerful banking houses in the world have to let wealthy stockholders pay on layaway, it means there is no cash floating around anywhere. The whole financial system is strained to the breaking point.
So acting on these basic conditions, he starts aggressively shorting the entire market,
betting on a total collapse.
And he was perfectly positioned for the carnage of October 24th, 1907. The text describes it as the worst panic in our history. The call money rate, which is the interest rate that brokers charge each other for overnight loans just to keep their businesses running, hit an unimaginable 150%.
150%.
The money post on the exchange floor, usually the bustling center of lending, was completely dead. No one had a single dollar to lend.
The text paints a terrifying picture of the chaos. Brokers were described as looking like mice in a vacuum bell, their sides heaving, gasping for air that just wasn't there. The entire street was flat broke.
It was utterly apocalyptic.
And then comes the legendary moment. J.P. Morgan, the titan of finance, sends a broker named John T. Atterbury to the floor of the exchange.
Right into the panic.
Atterbury raises his hand to the petrified, screaming crowd and announces that Morgan is personally providing a $10 million bailout just to keep the doors of Wall Street open.
This is the moment that truly defines our protagonist's maturity. Because of his massive, well-timed short positions, he had millions of dollars in paper profits as the market crashed.
He had all the leverage.
The market was so incredibly fragile that he could have easily hammered his short sales further, caused a total unrecoverable collapse, and made tens of millions for himself.
Instead, a banker reaches out and appeals to his patriotism, explaining that a total collapse of the American economy benefits no one.
So he does the logical discipline thing. He covers his shorts, locking in his massive profit, and then turns around and buys 100,000 shares of stock with his own money to help stabilize the market.
He walks away with over $1 million in cash.
He had finally evolved. He was no longer just reacting to the tape. He was anticipating probabilities based on fundamental economic conditions.
The papers called him king for a day. It is a stunning evolution. But I want to pivot from the history to the actual mechanics of how he operated once he reached this level of mastery. When you strip away the panic and the drama, how does an intelligent speculator actually place their bets?
Well, he developed some very specific rules, particularly when he was trading commodities like wheat and cotton that are incredibly counterintuitive.
Tell us about those.
The foundational rule he develops is trading along what he calls the line of least resistance. He learned to never argue with the tape and to never try to anticipate the starting signal before it actually happens.
Right.
For example, he talks about watching the price of wheat fluctuate aimlessly between $1.10 and $1.20 for months on end. Instead of guessing which way it would eventually break and tying up his capital, he simply waited.
He knew that if it finally crossed $1.20, it meant the upward pressure had definitively overcome the resistance.
You wait for the price to break through that mathematical limit, and then you buy. You go with the flow of the established force rather than trying to predict it.
And reading about how he executes those buys was fascinating. He uses a very specific scale and strategy.
Yeah.
He doesn't just dump all his capital in at once, even when he is incredibly confident. If his grand plan is to buy 50,000 bales of cotton, he starts by buying just 10,000.
Testing the waters.
Exactly.
Yeah.
If that first trade shows a loss, he stops immediately. He accepts that he is temporarily wrong, and there is no profit in being wrong. He will only buy the second batch of 10,000 bales if that first batch shows him a clear profit.
He forces the market to prove his thesis right before he commits more capital. It is a brilliant mechanism for risk control. But more importantly, it is designed to combat the ultimate psychological trap that the text highlights. Human nature is fundamentally backwards when dealing with risk.
How so?
When a trade goes against us, we naturally hope that it will turn around. We let our losses run because we hope tomorrow will be better, and so we end up losing big.
Right.
Conversely, when a trade goes our way, we suddenly fear that we will lose our paper profit. So we sell too early, we take a tiny gain to feel safe, and we completely miss the big swing that old turkey talked about.
We let our winners go and hold on to our losers.
Exactly. This raises an important question for you to consider listening to this deep dive. How often in your own life do you let hope and fear dictate your strategy instead of objective facts?
That is a tough question.
How often do you cling to a losing situation, hoping it will magically improve, while simultaneously abandoning a winning strategy the moment you feel a little bit of anxiety?
The protagonist realized that to succeed, he literally had to reverse his natural impulses. He had to learn to fear letting a loss get bigger, and actively hope that a small profit would grow into a massive gain.
It completely flips the script on human instinct.
It's so hard to actually practice. Well, let's wrap up this deep dive. We have followed an amazing trajectory from a 14-year-old chalk boy making $3.12 to a tape reader playing the margins in the bucket shops, to a true speculator who understood that basic economic conditions and patient sitting are the real engines of success.
And these sources prove that nobody can beat the market itself. The market is a force of nature.
But you can master your own methodology, your own discipline.
The final layer I took away from this is acknowledging that in any high-stakes environment, your greatest enemies are always boring from within.
From within yourself.
Right. It isn't the competition that defeats you, it is your own ego. It is your desire for shortcuts and insider tips. It is your total lack of patience. The market just provides the arena. The battle is entirely internal.
And that leads to a final thought I want to leave directly with you.
Yeah.
Our protagonist realized that taking a financial loss never really bothered him. What actually destroyed his soul was being wrong and failing to act on it.
That's powerful.
So think about the investments in your own life right now. And I don't just mean money in a brokerage account. Whether it is a creative project you are pouring hours into, a career path, a relationship, or even a long-held belief, are you holding on to a losing position simply because you're hoping for a miracle?
A miracle that might not come.
Exactly. Or are you ready to read the tape of your own life objectively, cut your losses without ego, and align yourself with your own line of least resistance? Thank you so much for joining us on this deep dive. We'll see you next time.